Welcome to History Hub. Today we will be revisiting the dot-com bubble and what caused it to crash. The dot-com bubble was a period of extreme growth and speculation in the technology and internet industry in the late 1990s. However, this growth was not sustainable, and the bubble eventually burst in 2000, leading to a major market crash. The dot-com bubble was fueled by a number of factors, including the rapid growth of the internet, advances in technology, and a general sense of optimism about the future of the industry. This led to a wave of investment in technology and internet companies, with many of these companies going public in initial public offerings, IPOs. As the dot-com bubble continued to grow, speculation and hype around the potential of technology and internet companies reached new heights. The speculation and hype that fueled the dot-com bubble was driven by several factors. One of the main drivers was the rapid growth of the internet and the rise of e-commerce. The internet was seen as a revolutionary technology that had the potential to change the way we lived and worked, and many investors were eager to get in on the action. Another driver was the media. The media played a significant role in building up the hype around the dot-com industry, with news stories, advertisements, and television shows all highlighting the potential of the internet and the dot-com industry. Many of these stories were overly optimistic and exaggerated the potential of the industry, which led to further speculation and investment. Investment banks and financial institutions also played a role in fueling the speculation and hype. Many of these institutions saw the dot-com industry as a lucrative market, and they helped to drive investment in the industry by offering new products, such as dot-com mutual funds and technology-focused stock portfolios. They also helped to take many dot-com companies public, which further fueled the speculation and hype around the industry. Finally, individual investors were also caught up in the speculation and hype. Many people saw the rapid growth of the dot-com industry and the large profits being made by early investors, and they wanted to get in on the action. This led to a massive influx of investment capital, much of which was invested in dot-com companies without careful analysis or due diligence. In 2000, the dot-com bubble finally burst, as the realities of the market caught up with the hype. Companies that were once valued in the billions of dollars saw their stock prices plummet as investors realized that they were not generating enough revenue or profits to justify their valuations. This led to a market crash, with many companies going bankrupt and losing their investors' money. The dot-com bubble crash had far-reaching consequences, affecting not only technology and internet companies, but also the wider economy. Many people lost their jobs, and the Nasdaq, which was heavily focused on technology and internet companies, saw a significant decline in value. However, the crash also had some positive effects, as it led to a more mature and sustainable approach to investing in technology and internet companies. The causes of the dot-com bubble crash were complex and varied, but a few key factors stand out. Firstly, the hype and speculation around technology and internet companies led to an unsustainable bubble, with companies being overvalued and unable to justify their stock prices. Secondly, many of these companies had business models that were not viable in the long term, and they could not generate enough revenue or profits to sustain their growth. Finally, the crash was also due to a general market correction, as investors realized that the prices of technology and internet stocks were not justified. The dot-com bubble crash was a valuable lesson in the dangers of hype and speculation in the stock market. It showed that even the most innovative and promising companies can fail if they are not backed up by solid business fundamentals and realistic expectations. The crash also demonstrated the importance of thorough due diligence and careful analysis when investing in technology and internet companies. The dot-com bubble crash led to increased regulation and oversight of the stock market, as well as the technology and internet industry. The goal of these measures was to prevent similar events from happening again, by ensuring that companies provide accurate information to investors and that markets are transparent and fair. The dot-com bubble crash was a significant event in the history of the technology industry and the global economy. It serves as a reminder of the importance of cautious investment and the dangers of speculation. Despite the losses suffered by many investors and entrepreneurs, the dot-com bubble crash also had a positive impact on the industry. It forced companies to focus on profitability and sustainable business models, which helped to lay the foundation for the growth and innovation that has taken place in the technology industry in the years since the crash. Today, the technology industry continues to thrive, with companies like Amazon, Google, and Facebook leading the way in terms of growth and innovation. However, the lessons of the dot-com bubble crash remain relevant, and investors and entrepreneurs must always be mindful of the risks and challenges that come with investing in new technologies and markets. The dot-com bubble crash serves as a cautionary tale about the importance of responsible investment, and the need for caution and careful analysis in the world of technology and finance.